What's up, guys? Welcome to the Coin Bureau podcast channel. My name's Jordan Crypt. If you're new to the channel, be sure to subscribe and stay tuned until the end of the video to get all of the important information. In this video, we're discussing how you can position yourself in a smart, risk-managed way into the fear that the cryptocurrency market is currently experiencing. We've all heard the adage, buy the fear, sell the greed. And this is really important when it comes to understanding emotions within trading and investing, and has been used by some of the smartest traders and investors in the world, such as Warren Buffett. And this all comes down to mindset, to understanding the FOMO that takes place within these cycles, and being able to flip the fear that the market is experiencing into your own greed, and to be able to do this in a slow, calm, smart, risk-managed way. As we can see by the Fear and Greed Index here on Bitcoin, the market is currently in extreme fear, which means that as long-term investors, we should be thinking about accumulating and positioning ourselves so that we're able to sell and take profits the next time that this market is in greed. And if you are like me, I do believe that this market is currently experiencing a normal correction according to its history, and that greed and euphoria will eventually come back into this market. It's just a matter of really being honest with ourselves that we don't know when this is going to happen. The bear market could continue for an indefinite amount of time, and we could go down to lower levels that we actually can't predict. If we look at the history of the Fear and Greed Index over time, we can see correlations between extreme fear zones and accumulation phases on the charts before big rallies to the upside. Again, we need to be honest with ourselves that we don't know how low into fear we will go or how long the fear will last. We can take the current Bitcoin bear market and measure it against previous bear markets that have also aligned to the 4-year cycle to give us a vague understanding of how much further down it is likely that we will go. But again, there's no predicting this, as at any time, black swan bear catalysts could come into the market, or positive catalysts like massive institutional liquidity injections. There are lots of charts and metrics that we could look at currently, such as this Bitcoin exchange to whale ratio on crypto Quant, which is suggesting that Bitcoin is entering into an accumulation phase. But again, we don't know how long this phase will last or how much lower the prices will go. There are also some very bearish indications on the charts that are suggesting much lower levels for us, such as this cross that has printed between the 50 and the 200 moving averages on the 3-day time frame. Here we can see it printed, and the last time this happened, we did see a massive resulting drop into the true whale accumulation zone of that last bear market, and the confirmation of that consolidation phase as a bear flag. Looking at current price, if that does rhyme and confirm this current consolidation phase as a bear flag for us, then we are looking at much lower targets for the real accumulation zone and actual crypto winter. Looking at the Ethereum chart on the weekly time frame, we are down towards the value area low of a range that has been lasting for years. If you still believe in the use cases of Ethereum, like I do, then it would seem inevitable that over time we will test that POC and come back in to the higher levels at the value area high of this range. It's just a matter of how much lower we could potentially go before this happens, and how can we make sure that we are using these lower levels to our advantage. So, this all being said, if you are an investor like myself who has not given up on the fundamental use cases of Bitcoin and potentially those of Ethereum or altcoins, then we need to think about how we can position ourselves in the smartest way possible, taking into account the possibility of all of the risks and any eventuality. Getting now into the meaty content of this video, I'm going to share with you 3 strategies that you can use for a holistic outlook on how to position yourself within this fear. These are strategies that I've used as a well-rounded investment plan in previous cycles, and it has served me extremely well. Number 1 is dollar cost averaging. Number 2 is setting up ladder limit entries. And number 3 is buying the dip, which is often very much misconceptualized. The idea is to take the amount that you would like to invest into this asset during the fear and then split that into 3 equal portions across these 3 strategies, which act holistically to serve the larger trading plan of buying the fear and selling the greed. Dollar cost averaging is a fairly straightforward and simple principle, but is extremely important and serves as the core of this strategy. I do have a full tutorial on dollar cost averaging on my personal trading channel, so check it out if you'd like to. Dollar cost averaging is to buy equal amounts at equal time frames consistently, regardless of price, as long as we are within fear. This means that if you set up your buys for a weekly time frame, you're buying equal amounts at every single weekly candle. This is a very strong strategy, as if we go up at any point and you continue to buy every weekly candle, you are riding the trend. And if we go lower, you are managing to buy into the fear and accumulate your position. And if Bitcoin does come back up in future, you are creating for yourself the smile curve. You can set these dollar cost averaging buys to monthly, weekly, daily, or even lower timeframes. Personally, I set mine to the daily. It's just very important to make sure that the 1/3 of the total investment amount you have for the bear market is split into small enough amounts that you can stretch it out over at least the next year to buy consistently at those small amounts at every time frame that you choose. The major mistake that a lot of people make here are to make their consistent buys too large, and then they run out of capital to fund their dollar cost averaging while price is still going lower, and then they're stuck in a position where they have to wait to come back up or above their previous loss buys. You want to keep your buys small enough so that you are able to get into all of the buys on the smile curve. The next concept is the ladder limit entries. This is slightly more complex, but still, in my opinion, a fairly easy concept to understand. The idea here is to set ladder limit entries at horizontal levels on the charts, going down as low as possible. There are several ways to do this according to personal preference. You can set equal distances between your buys and equal amounts, or you can set your buys closer together as you get lower down, with larger amounts towards the bottom. What I like to do here personally is set my buys at round mental levels, like 60,000, 55,000, 50,000, etc., all the way down to $10,000 in case of a black swan event that does wick low, so we can catch those lower ladder limit entries. My personal preference here is also to increase the amounts in my ladder limit entries as I get lower down, which means that there's a high chance that the biggest amounts will actually not go off and I will retain that liquidity in stables. But if we do reach much lower levels, that's when I'm happy to actually deploy that higher margin into Bitcoin, as it's more likely to give a higher return. Many platforms do allow advanced tools which help you to set these ladder limit entries. Personally, I like to do this manually and do the maths myself. So the next one is buying the dip. And this is really highly misconceived by so many investors and especially newbies. What you need here is a very strong metric that can help you understand, is this a real dip that has a high likelihood that we can trust it, or is this just further continuation to the downside, in which case we shouldn't be using the 1/3 that we have set aside to buy this dip. There are 2 indicators that I would suggest here to help you understand when to buy the dip, and these are used on different time frames. The first one is the regular RSI on the weekly time frame. We can see here that within historical cycles, the weekly RSI has been a reliable indication in the oversold zones that it is a good time to deploy some capital into buying the dip. One thing to take note of here is that there usually does come in a manipulation after that zone, which gives us a bullish divergence on the charts. And this is where your ladder limit entries can give you a little bit of an edge on the market. The next one that you can also use is the stochastic RSI on the monthly time frame. There is also a bit of a nuance here in that this stochastic can spend some time in the oversold region before moving back out. So what you want to look for here is a clear break of the stochastic against its moving average, and then a clear trend in direction towards the momentum zone in both the stochastic and its slow moving average. I really hope this has been useful. It may seem quite simplistic, but this really is so powerful, as it allows you to position yourself through fear with great risk management. Please let me know in the chat if you have any questions. I'd be happy to answer them. And remember to follow these instructions to make sure that you don't do this wrong and shoot yourself in the foot.